Hello everyone, welcome back to the course Strategic Management Accounting. Topic 5, Strategizing Performance Management. This topic is organized around two fundamental questions. What do we mean by performance and how do we manage performance? The answers to these two fundamental questions depends on the approach that we may follow. We have two approaches, traditional approach and the strategic approach. Accordingly, as a learning objective, we would first explore the philosophies, concepts, structures, techniques and tools and the procedures involved in the traditional approach to manage performance. We will also talk about the weaknesses of the traditional approach. Then, as our second learning objective, we will explore philosophies, concepts, structures, techniques and tools, and the procedures involved in the strategic approach to manage performance. And we will also talk about the weaknesses of the strategic approach. So this is how this topic is organized. Now, what do we mean by performance? Perhaps as a starting point, it could be a good idea to differentiate between performance and doing. People do various things. People carry out various things. For example, people may dance, sing, write, produce, manage, and so on. And these doings or these actions become performance when they are subject to observations, evaluations, and judgments. So in that sense, performance is those actions, those behaviors, and their outcomes subject to observations, evaluations, and judgments. So that is how we understand performance in a very broader sense. To repeat it again, the performance are the behaviors, actions, and their outcomes subject to observations, evaluations, and judgments. And performance are very context specific. The meaning or the manner in which we understand performance is rather dependent upon the specific context in which we observe, we evaluate, we assess, and we judge the behaviors, actions, and the outcomes. For example, the performance may be evaluated and judged at very individual level. The performance of an employee. Or the performance may be evaluated, assessed, and judged at departmental or divisional level. Divisional performance or departmental performance. And similarly, performance may be evaluated at organizational level. The organizational performance as a whole. Or even the performance may be evaluated at country level, as the World Bank does in World Bank reports, using various national accounting techniques. And similarly, the manner in which you evaluate, assess, observe, and judge performance may be quantitative. In certain occasions, performance can be measurable. And accordingly, we can judge them very objectively based on some numerical standards, numerical criteria. But in certain other occasions, the performance cannot be easily measured. And in that sense, we might have to use some qualitative criteria. So the performance may be observed, evaluated, assessed and judged either quantitatively or qualitatively with objective criteria or in rather subjective manner. So the manner in which we understand performance is context specific. However, one way or the other, performance basically try to evaluate and judge how an individual or a department or the division appreciate and contribute to a large schema of things. For example, we may assess an individual performance on the basis of how far that individual actions contribute to the profit, or that individual action contribute to the cost reduction, or that individual behavior, actions and their outcomes contribute to the efficiency, productivity and creativity, flexibility and so on, or quality and so on. So the performance, one way or the other, try to observe, evaluate, assess and judge how a particular unit, entity or an employee contribute to a bigger schema of things, including corporate goals, corporate strategies, corporate objectives and so on. And this performance may be measured against the predetermined, preset objectives, targets and expectations. So in order to evaluate the performance, observe and assess and judge performance, we would have a set of predetermined objectives, targets or any other form of expectations. Then we would compare the actual behavior, actual outcomes, actual actions of this employee or the department or the organization with the expected or desired. So in that sense, performance management is a form of management control. Therefore, some accounting scholars identify performance management as a sub-element of the total management control system. Because the performance management involves setting predetermined or desired level of performance and then observing and measuring, judging and evaluating the existing or the actual level of performance against those desired level of performance, and then finally taking corrective actions. So in that sense, performance management is a form of management control, but with clear set of system or procedures or elements through which we manage, observe, judge, evaluate performance. And then, in certain occasions, when we are trying to judge the outcomes of actions, behaviors, we understand that those outcomes are not controllable. This particular individual employee or this particular department or for the organization as a whole, that outcome is not controllable. It is rather because of something else. Therefore, blaming this particular employee or the department or organization for that particular outcome is not fair. So when it comes to the performance management, the concept of controllability becomes very, very critical. And that notion of controllability is yet again very context specific. What is controllable for an employee under a particular context or circumstance is not what is controllable under a different context. So in a broader sense, performance are context specific. The manner in which we understand, We evaluate, we observe, and we judge people's behaviors, their actions, and their outcomes depends on the specific context in which they occur. So that is how we understand in a very broader sense what do we mean by performance. So to summarize, performance are behavior, actions, or outcomes which are subject to observations, evaluations, and judgments. And such observations, evaluations, and judgments are context specific. The manner in which we observe, evaluate, and judge behavior, actions, and the outcomes depends on the specific context in which they occur. The traditional approach to manage performance is called responsibility accounting. The philosophy behind traditional approach or the responsibility accounting is that in order to manage performance of an organization, all the activities carried out by the organization should be conceptualized and organized into 4 categories of centers. And then these 4 categories of centers should be arranged hierarchically. These 4 categories of centers involves first the cost centers, then revenue centers, profit centers, and investment centers. They are hierarchical. At the very bottom of the organizational hierarchy, we have cost centers. The cost centers represent the very basic activities, mostly production activities carried out by the organization. And these activities generate cost. And these activities are the reason for the cost of the organization. Therefore, the cost centers carry out, organize, and manage these activities. And their performance should be observed, evaluated, and judged on the basis of the cost. And for each of these cost centers, a particular manager should be appointed. And that manager should be accountable and responsible for the performance of that particular cost center. And his or her performance and that center's performance would be evaluated by various cost dimensions, various criteria of cost or various types of cost. And there are a number of such cost centers to capture everything that an organization carry out. So that is the first category of centers to which performance management is delegated, attributed. And then besides them, we have revenue centers. The revenue centers are those centers in which the sales income is generated. For example, a particular unit responsible to sell a given product category. The managers of that particular unit is responsible and accountable for that sales income. So therefore, their performance will be predominantly assessed, observed, and judged on the basis of various definitions of sales. And then above them, we have profit centers. Profit centers are the centers which consolidate various cost centers and the revenue centers together. A particular set of cost centers and a revenue centers would be consolidated into one profit center. and there would be a higher level manager accountable and responsible for that profit center. His or her performance will be observed, evaluated and judged on the basis of various definitions of profit, such as gross profit, net profit and so on, or profit margins, say margin on sales or whatever it is. So that is the third category of centers. And then finally, at the very highest level, we have investment centers. So investment centers consolidate many profit centers. Investment centers are responsible for, accountable for long-term investment decisions. Therefore, their performance will be observed, evaluated and judged on the basis of return on investment. Various definitions of return on investment. So that is how the organization is conceptualized and organized under the traditional approach or the responsibility accounting approach to manage performance. So the philosophy is distribute the overall organizational activities and performance into 4 categories of centers, which can be hierarchically arranged, so that the accountability and responsibility of each center can be specifically attributed to a manager, making him or her accountable and responsible for the performance of that particular center. And then various concepts such as cost, revenue, profit, return on investment should be used to observe, evaluate, and manage the performance of these centers. So as a philosophy, you would understand the responsibility accounting or the traditional approach to manage performance is financially driven. All the criteria that we use are fundamentally economic or financial. Cost, revenue, profit, and return on investment. And then the traditional approach or the responsibility approach is operational directed. So what this responsibility accounting capture is the operational dimensions of the organization. How do we manage our activities at the cost centers? How good we are keeping our cost under control? And then how good we are generating income? And how good we are creating profits? And how good we are generating a sufficient return on investment for our investment. Mainly in the short run or in a mid-term investment span. So that is the overall conception and the philosophy behind the traditional approach or the responsibility accounting approach. Then the most popularly used, predominantly used technique or tool for responsibility accounting is budgeting and standard costing, including sometimes various operational analysis using financial ratios. For example, at the level of the cost centers, we would conceptualize, observe, evaluate and judge the performance on the basis of cost standards. Standards for material usage, labor usage, overheads and so on. So we would have a predetermined standard cost. The standard material cost, standard labor cost and standard overhead cost. Then we would measure periodically, monthly, quarterly, weekly, the actual cost incurred in these cost centers. And then we compare the actual cost with the standard cost. to identify whether there is any unfavorable variance. And if there is any unfavorable variance, then the cost center manager has to explain why that particular unfavorable variance and what actions are to be taken to avoid that unfavorable variance in the next accounting period, in the next operational cycle. So that's how we manage. And a similar set of standards will be imposed upon the revenue center managers and the profit standards as well. And ultimately, we would have a target level of return on investment, and we check whether that particular target level of return on investment is achieved or not. If not, why? The investment center manager has to explain it and determine the corrective actions to mitigate any unfavorable variances. So when we think about performance management in that manner, so we have two interrelated dynamics here. The first one is what we call intra-center or within the center management of performance. For example, within a cost center. In order to manage the cost or in order to keep the cost under control within the given cost center, we use standard cost budgets and so on. So the cost center manager would concentrate on the activities in the center to keep it under control. So that is what you call intra-center or intra-departmental or within the departmental management of activities. And then we also have to understand how each of these centers ultimately connect to each other or becomes a part of a bigger schema. How each of these cost center, revenue center, profit center and investment centers constitute the total organization. How each of these centers ultimately contribute to the overall organizational objectives of return on investment. For that particular purpose, we would produce master budgets, the budgeted profit and loss account and the budgeted balance sheet. And also we would carry out an organizational level financial analysis of ratio. For example, we may use DuPont system of ratio analysis. The DuPont system of ratio analysis break down the return on investment into its sub-elements. How this return on investment is generated by various elements such as cost, revenues, and so on. So that's how we conceptualize and we manage the interdepartmental or inter-center connections. So to repeat it again, there are two dynamics associated with responsibility accounting. Managing the dynamics within each center and then managing the connection between these centers. So in a broader sense, responsibility accounting or the traditional approach to manage performance conceptualizes the organization or organize the organization into 4 categories of centers, which are hierarchically arranged. The cost, revenues, profit and investments are the 4 key concepts according to which performance is conceptualized, observed, evaluated and judged. So we have cost criteria, revenue criteria, profit criteria as well as investment criteria to judge the performance. And we use techniques such as budgets, standard costing and ratio analysis to analyze the performance, to manage the performance. And a specific manager would be attributed, assigned to each of these centers so that that particular manager is accountable and responsible for the performance of that center. Then that's a very important concept that we have to talk about. That the concept of controllability. The fairness of this responsibility accounting stems from the notion of controllability. That basically means there may be certain cost incurred in the department which is beyond the control of the cost center manager. So there are certain unfavorable cost incidents, cost occurrences happened in the center, and that incident is nevertheless cannot be directly controlled by the manager of that particular center. So therefore it would be very unfair to judge the cost center manager's performance on the basis of something that he or she cannot control. So therefore, when we are conceptualizing various cost measurements, we need to consider whether those cost elements, those cost measurements are controllable by the cost center itself. If not, they should not be used to evaluate, observe and judge the performance of that center. So which is equally applicable for revenue centers, profit centers and investment centers. So whether the criteria based upon which we evaluate, observe and judge the performance is controllable for that particular center manager. So that controllability, the concept of controllability, provide a sort of fairness to the system. So that is the overall picture, overall image about traditional approach to manage cost. So to summarize, traditional approach conceptualize the organization into centers, 4 categories of centers. And then each center will be assigned to a manager. And that manager would then become accountable and responsible for the performance of that center. And the performance of that particular center should be managed by taking the notion of controllability into account. And the performance of each center would be managed on the basis of either the cost, revenue, profit or return on investment. Therefore, the traditional approach is predominantly financial oriented and operational driven. Together with budgeting and standard costing, responsibility accounting has been the most popular and the prominent system of performance management for around a century. However, since 1980s, that is, since the strategic turn which we discussed in our previous lectures, responsibility accounting was subject to a severe critique. It was criticized for not being able to deal with the new competitive conditions that the neoliberalization of politics, globalization of markets and hierarchies, and the digitalization and virtualization of technologies brought about. Many weaknesses were highlighted. For example, responsibility accounting was criticized for its excessive centralization. Responsibility accounting systems demand a centralized hierarchical order to coordinate various budgets and the standard costing system. And as a result, responsibility accounting system is too rigid, too inflexible system to deal with the contemporary volatile competitive conditions. And also, responsibility accounting systems were criticized for creating some inefficiencies, especially in terms of budgetary slacks. And then, Responsibility accounting creates an unnecessary competition between subunits or divisions of the organization for budgetary allocations, resource allocations. And also, responsibility accounting systems tend to repeat the past with incremental budgeting, just marginally changing the previous year budget for this year. And more than anything else, there are two specific weaknesses that the strategic gurus like Johnson and Kaplan highlight. The first one is responsibility accounting systems only considers the financial dimension of performance. It is lopsided towards the financial dimensions, or in other words, it is not balanced. It creates a particular understanding of the organizational performances, but only through financial dimensions. As we discussed so far, the responsibility accounting system observe, evaluate and judge the behaviors, actions and the outcomes in terms of either the cost, revenues, profits and return on investment. So therefore, the responsibility accounting system does not have the capacity to capture various other dimensions or critical performance dimensions that we have to consider in contemporary competitive conditions. So, responsibility accounting systems are not balanced, financially lopsided. And the second critical weakness that Johnson and Kaplan and many other strategy gurus highlight is that the responsibility accounting system cannot deal with the strategy. It does not create an appropriate connection between the corporate strategies and the operations. So there's a disconnection between the strategy and operations. So these are the most fundamental, critical weaknesses. The problem of balancing and the problem of link between strategy and operations that many strategy gurus emphasized. And the strategic performance management systems came into being to address these two issues. Especially the Balanced Scorecard was proposed to address these two issues of the lack of balancing between the financial and non-financial performance dimensions and lack of connection between or the link between operations and strategy. With that broad understanding of responsibility accounting and its weaknesses, we are now in a position to talk about strategic performance management. The most popular and the prominent strategic performance management framework is the one proposed by Johnson and Kaplan, the famous Balanced Scorecard framework. In an overall sense, I would interpret Balanced Scorecard framework as a conceptual framework that tries to enact and enable strategies within the organizational hierarchy, within the control apparatuses of the organization by carrying out two analytical or evaluative actions. The first one is balancing and the second one is linking. Balancing means here balancing between financial and non-financial dimensions of measuring and managing performance. As we already discussed, the responsibility accounting system is lopsided and only capture the financial dimensions of performance. the responsibility accounting only evaluate, observe and judge the behaviors, actions and their outcomes in terms of cost, revenue, profit and return on investment. So it is financially biased, financially unbalanced. So in order to correct this fundamental weakness of the traditional performance management system, Johnson and Kaplan brings in another three critical performance dimensions. So accordingly, Johnson and Kaplan's framework incorporates four critical dimensions of managing performance. The first one is finance, the financial dimension. As in the case of responsibility accounting, still even in the balanced scorecard, the financial dimension plays a critical role. It is the first dimension. So still we need to assess the performance in terms of cost, revenue, profit, return on investment, liquidity, solvency, gearing and so on through various financial dimensions, through various accounting measures. So that is there. So in that particular aspect, Johnson and Kaplan ask us to ask a fundamental question. That is, to succeed financially, how should we appear to our shareholders? So that is the very first question, according to Johnson and Kaplan, that we should ask in conceptualizing, in framing, and in designing our performance management system. So we have to measure, we have to evaluate how far we can satisfy our shareholders, how far the corporation, its divisions, its employees are able to contribute to the maximization of shareholders' wealth, to provide a sufficient return to the shareholders. That is the very first dimension. And then secondly, in order to generate sufficient income, sufficient return on investment, we should be able to satisfy our customers. We should be able to compete in the market so that we can create a particular positioning, a particular brand loyalty, and we can have a sufficient market share. So that means Johnson and Kaplan ask us to ask the second question. To achieve our vision, how should we appear to our customers? So that is the second question that we have to ask in conceptualizing, in framing, and in designing our performance management system. The customer perspective or the market perspective. How should we appear to our customer? That means how should we position our brand, our product and our services in the market. And then, in order to achieve a particular positioning in the market, in order to appear to our customers in a particular manner, and thereby to satisfy our shareholders, we should have a solid set of very efficient, productive, flexible set of internal business processes. So we should have a set of internal business processes which can produce and deliver what the market demands. So that is the third dimension of performance evaluation according to the balanced scorecard. So Johnson and Kaplan ask us to ask the question. To satisfy our customers and our shareholders, what business processes must we excel at? So that is the third question that we have to ask in designing, conceptualizing performance management system. So we have to conceptualize, we have to measure, and we have to evaluate, and we have to judge how far our internal business processes are capable of producing and delivering what the market demands. And then finally, such a internal business processes and our capacity to continually satisfy the customer is a matter of how good we are at learning and growing. So the organization as an entity, its departments as its subunits, and its employees should be capable of learning and growing. So in that sense, Johnson and Kaplan ask us to ask the fourth question. That is, how will we sustain our ability to change and grow? So that is learning perspective. So these are the four perspectives according to which we have to evaluate, we have to observe, and we have to judge our performance. Financial, customer perspective, internal business processes, and learning and growth. So these four dimensions are proposed to create a balance between financial and non-financial. So as a strategic performance management system, Balanced Scorecard try to balance between financial and non-financial by proposing four key performance measurement dimensions. And then Johnson and Kaplan also conceptualizes a particular causality between these dimensions. So according to them, at the very bottom of this causality, there is learning and growth. The firms and its members, its elements, its department and division should learn and grow, should be capable of changing with the changing environment. So when the company is capable of learning and grow, when the company's sub-elements and employees are capable of learning and grow, then the business processes will become productive, flexible, agile, and capable of meeting the market demands. So the learning and growth leads to better internal business processes. And then when we have the better internal business processes, that leads to our capacity to satisfy our customer, to appear to our customer in a particular manner. So that is the next level of causality. And then when we are capable of satisfying our customers, when we are capable of appearing to the customer according to a particular positioning strategy, then we can generate sufficient income, sufficient profit, and return on investment for our shareholders. So that is the causality that Balanced Scorecard framework presumes between these four dimensions. So accordingly, we should try our best to excel at learning and growth, and that will make us better in the internal business processes, and that will make us better appearing in the market, and that will enable us to satisfy our shareholders. And then, when it comes to the analytical or evaluative task of linking, scorecards play the critical role. Linking here means connecting the operational activities of the firm, the day-to-day operational activities of the firm with the strategy. So as we discussed earlier, the traditional responsibility accounting system was heavily criticized for lack of connection between the operations and the strategy. So, the Balanced Scorecard framework proposes a connection between the operations and strategy through scorecards. A scorecard is a kind of a template or a document that spell out those four key dimensions in terms of objectives, measures, targets, and initiatives. So in that sense, for each of these four key dimensions, we need to have a specific set of objectives, measures, targets, and initiatives. So the balanced scorecard or a scorecard contains specific statements about those four things: objectives, measures, targets, and initiatives. And we prepare scorecards for every element, every unit in the organization, from top to bottom. So, in other words, we cascade those scorecards from top to bottom. So, it is the scorecards, when they are cascaded, which creates the connection between operations and strategy. So, accordingly, if you are implementing a balanced scorecard system in a company, at the very top level, the company should have a consolidating scorecard for the company as a whole. So, in that scorecard, the financial dimension should be very clearly spelled out in terms of financial objectives, corporate objectives in the field of, in the area of, or in the domain of financial performance. And then those objectives should be further spelled out into specific set of measures. So what are the measures according to which you conceptualize and you measure these objectives? And then for each measure, you need to have a specific target. So the objective is spelled out into the measures, and then the measures are being operationalized into specific targets. And then finally, the scorecard should also spell out the specific program, plans or initiatives through which those targets, those measures and those objectives are to be achieved. So that's what a scorecard would do. A scorecard would clarify, spell out each dimension in terms of objectives, measures, targets, and initiatives. For finance, we have same four elements. For customer perspective, we should also have those four elements. And for internal business processes, we should have those four elements. And for learning and growth, we should have those four elements: objectives, measures, targets, and initiatives. So that is a scorecard. Then that scorecard has to be cascaded. So we start with the top level, corporate level scorecard. Then it has to be broken down into divisional scorecards. And the divisional heads would be accountable and responsible in developing a divisional level scorecards which connects to the corporate scorecard. And then subdivisional level or departmental level scorecards to connect to the divisional scorecards, to articulate how that divisional scorecard is operationalized through many other scorecards. And then like that it goes down until the individual employee level. The all key employees, key managers would have a scorecard spelling out their objectives, measures, targets, and initiatives. So the employee scorecard, departmental scorecard, and so on should spell out this is the objective for the next year. next 2 years or next quarter and so on. And that objective is to be measured in this particular manner. And here is the specific target regarding that objective. And this is how we are going to achieve it. This is the specific program, plan or initiative we want to carry out in order to achieve those targets. And that cascading is the connection. That is the way the link between the operations and the strategy is to be created and sustained. So in an overall sense, Balanced Scorecard provide a particular conceptual framework according to which we carry out two analytical or evaluative actions: balancing and linking. Balancing means balancing between financial and non-financial, and that is done by incorporating four key dimensions: financial, market, internal processes, and learning and growth. And then the connection between operations and strategy is done through the scorecards, which should spell out objectives, measures, targets, and initiatives. And such scorecards cascade from top to bottom. So that's the overview, the overall image of Balanced Scorecard as a strategic performance management system. Now, let's talk about some fundamental problems of Balanced Scorecard framework. As you already understood, Johnson and Kaplan locate the strategy at the very center of the Balanced Scorecard framework. Everything and everyone should be connected, linked with the strategy. Everything and everyone should be directed towards the strategic goals of the company. Accordingly, Johnson and Kaplan argue the strategy plays a very centric role in the Balanced Scorecard framework, and therefore Balanced Scorecard framework is a strategic performance management framework. However, when you read Johnson and Kaplan, you don't get a clear understanding of what actually they mean by the term strategy. At its best, you would understand that they approximate the notion of a strategy to a vision statement, some sort of long-term goals toward which everyone and everything should be directed. On the other hand, when you read papers by Mintzberg, for example, you will understand that strategies can come into being in so many different ways. Strategy can be a plan, or it can be a ploy, or it can be a perspective, or it can be a pattern in action, or it can be a particular position that the company holds in the competitive terrain. And strategies can be rational, predetermined thing like a plan, or it can be just emergent, like a pattern in action. It can be very vague perspective about the manner in which one would think about, one would understand the competition. And the strategies come into being in so many different ways in a rather context-specific manner. Strategies can be enabled and enacted differently in the market. And similarly, strategies can be enabled and enacted differently at the point of production or within the organizational hierarchy. This means that strategies are very complex, dynamic idea. Strategy can come into being in a so dynamic, different contextual manner. And this complexity, this dynamic nature of strategy is not captured by the balanced scorecard framework. Instead, it has a rather simplified idea about strategy as a kind of a vision. And more than anything else, the balanced scorecard framework has a very problematic presumption about strategy. That is, there is a pre-existing strategy, which is very clear, well communicated to everyone in the organization. So everyone in the organization has a clear understanding, clarity about the strategy, so that they can design their own scorecard connecting their domain of actions, their behaviors, their outcomes to the strategies. So master strategy or the master scorecard manifests strategy, and that is very clear to everyone. And everyone else therefore can create their own scorecards to connect their actions, their behaviors, their outcomes with that pre-existing, well communicated, well understood strategy. This is a rather problematic assumption. In the real world, people don't have such a clarity about strategies. Strategies are not necessarily pre-existing like that in a rational manner, documented manner. They emerge, they dynamically evolve, they change. So, one of the fundamental problems of balanced scorecard framework is the manner in which it assumes, it conceptualizes the notion of strategy. And then, very similar to responsibility accounting system, balanced scorecard also demands a highly centralized, top-to-bottom, command-driven organizational hierarchy or organizational configuration. As Johnson and Kaplan explains in one of their papers, implementation of balanced scorecard starts from the very top. So they assume that the top-level managers, visionary managers, strategic leaders, with the help of external consultants, would determine their corporate strategies, corporate vision, and then spell out their corporate vision and strategies in terms of those 4 critical performance dimensions: finance, customer perspective, internal business processes, and learning and growth. And then accordingly, they would set a specific set of corporate objectives to cover all these dimensions. And then they would have targets, measures, and initiatives. Basically, at the very top, by the visionary leaders, strategic leaders, with the help of external consultants, would have a consolidating master scorecard to cover the whole organization, to represent the total organization. So that's the beginning. And then that idea, that vision about the organization would be pushed down, commanded down to the next layer of managers. So the next layer of managers would be called upon and demanded to create their own scorecards to connect their domain of operations to the corporate scorecard. And then it goes down like that. So from top to bottom, highly commanding, centralized organizational structure, organizational configuration. Very similar to the very performance management system, the responsibility accounting system that Johnson and Kaplan criticize. Johnson and Kaplan criticize the responsibility accounting system being very rigid, not flexible enough, not agile enough. And hence, the organizational structure, organization should be learning and growing. But when you think about the manner in which the balanced scorecard are to be implemented. When you read the Johnson and Kaplan's own prescriptions about the manner in which balanced scorecards are to be implemented, you understand that it demands a highly centralized, command-driven, top-to-bottom organizational structure. So that is the second fundamental problem of balanced scorecard. Then thirdly, the balanced scorecard also assumes an apolitical or non-political organization. So they assume that these strategic leaders, visionary leaders, with the epistemic help of the external consultants, can come out with a wonderful idea. And then that wonderful idea, that vision, that strategy can be simply told to the people at the bottom. And the people at the bottom would take it and simply follow it. They wouldn't. In the real world, they wouldn't. They would resist. Because people work in organizations for years and years. They have their own rituals, micro rituals, their own system of work, their own values, beliefs, their own relationships that they are maintaining for a long, long time. They don't want them to be disturbed easily. They don't want those existing pattern of work, system of work, habits of work to be dismantled easily. So they will resist. So when a certain balanced scorecard project is coming down from the top, as Johnson and Kaplan believes the people at the bottom would not take it, oh yes, we are ready, give it to us. No, they won't. They fight. They resist. So implementation of balanced scorecard in that manner is not going to be easy, because in real world, organizations are highly political institutions. The organizations are political sites in which you see various kind of struggles, contradictions, conflicts, and so on. So, the implicit assumption that the balanced scorecard hold about the organization as a non-political, smooth organization is rather problematic. And then, the fourth fundamental problem, as we already discussed, balanced scorecard assumes a particular causality between those four key or four critical performance evaluation dimensions. The balanced scorecard assumes that learning and growth will lead to better internal systems, and that better internal systems will lead to a better position in the market, a customer perspective in the market, and that will lead to better financial outcomes. And this causality is rather problematic. In empirical sense, this is very difficult to be validated. For example, in one of the wonderful paper written by Noreklit, she argues that the causality that the balanced scorecard assumes is not a causality. It is instead a finality. It is a desire. It is a kind of a expectation by the manager. So if you do this, this should happen. And if that happens, this should happen. And if that happens, this should happen. So there is no empirical support, empirical validity in this causality is presumed by the balanced scorecard. Instead, it operates as what Noreklit call a finality, a desired normative connection, not a causal connection. So it could be a good idea to read Noreklit paper to have a better understanding about what she talks about this particular problem in the balanced scorecard, the problem of causality. And then finally, balanced scorecard as a project is a very expensive, very difficult to implement idea. As I already said, there are political issues of implementing it. There is a problem of clarifying the strategy. And this balanced scorecard framework projects involves high amount of investment. You have to bring the consultants, you have to have various kind of meetings, and you have to spend a lot of time designing mastercards and scorecards and so on at every level of the organization. This is a very time consuming, highly expensive project to be implemented. And sometimes managers wonder whether there is actually a benefit that would justify the cost and time to be invested in such a project. So these are the fundamental problems of balanced scorecard. The problem of the manner in which balanced scorecard conceptualized strategy, and then the top-down approach that it assumes, and highly rigid hierarchical organizational configuration that it assumes, and then the apolitical nature of the organization that it assumes, and then the causality that it assumes, and also the problems of implementation. So these are the fundamental problems of implementing or understanding or conceptualizing performance management as balanced scorecards. Now, with that, we have reached the end of this lecture. As usual, I will conclude the lecture with a summary. This lecture was about performance management, strategic performance management. However, before we talk about strategic dimensions of performance management, we had a discussion about traditional performance management system, which is understood as responsibility accounting. According to responsibility accounting systems, the organization should be structured or divided into 4 categories of performance centers: cost centers, profit centers, revenue centers, and investment centers. Each of these centers would be attributed or assigned to a particular manager, and that manager would be held accountable and responsible for the performance of that center. A cost center would be observed, evaluated, and judged on the basis of various cost criteria, various definitions of cost. And a revenue center manager would be observed, evaluated, and judged on the basis of various revenue concepts, together with some relevant cost concepts as well. And then profit centers consolidate a given set of revenue centers and the cost centers. And a profit center manager would be evaluated, observed, and judged on the basis of various definitions of profit. And then finally, we have investment centers. Investment centers consolidate a specific set of profit centers. And the investment center managers are responsible for long-term investment decisions. Therefore, their performance are observed, evaluated, and judged on the basis of return on investment or various definitions of return on investment, together with, for example, DuPont analysis of return on investment. So that is the old traditional responsibility accounting system. And then, with many other weaknesses, the responsibility accounting was criticized on the basis of 2 fundamental weaknesses. There are many other weaknesses, but 2 fundamental weaknesses are emphasized. One is that the responsibility accounting is financially unbalanced, lopsided toward financial performance only. And The responsibility accounting does not link operations with the strategy. So there are two problems, the problem of balancing and problem of linking. Then Johnson and Kaplan's Balanced Scorecard came into being to address these two fundamental issues, balancing and linking. Johnson and Kaplan proposes the Balanced Scorecard to balance between financial and non-financial dimensions of performance management. Accordingly, they propose four key critical dimensions of performance management: financial dimension, customer dimension, internal business process dimension, and learning and growth dimension. So the performance of a company and its sub-elements should be assessed, observed and judged according to these four critical dimensions. And Johnson and Kaplan also understand that there is a particular causality between these dimensions. Learning and growth should lead to better internal business processes that should lead to a better customer perspective or better positioning in the market, and that would finally lead to better financial returns. So that is the causality that the Balanced Scorecard presumes. And then to link the operations with the strategy, Balanced Scorecard framework proposes a series of scorecards. A scorecard need to be prepared at the very top of the organization as well as at the very bottom of the organization, cascading down from top to bottom. So it is this cascading of scorecards that create the connection between operations and the strategy according to Johnson and Kaplan. A scorecard would spell out objectives, measures, targets, and initiatives for each of those four critical performance evaluation dimensions. Therefore, a scorecard would contain specific set of statements about each of these critical performance dimensions, spelling out objectives, measures, targets, and initiatives. So that is the overview of the Balanced Scorecard as a framework. Then we understood there are some fundamental problems with the Balanced Scorecard framework. One of the problems is its rather problematic conception of strategy. Second problem is it also assumes a highly rigid, top-down, hierarchical organizational order. And thirdly, it assumes that the organization is rather non-political, apolitical. The people at the bottom would simply follow whatever the things that the people at the top tells them. And then the problem of causality. The causalities that the Balanced Scorecard assumes is rather problematic. According to Noreclit, they are not causalities but finalities. And then finally, the implementation of Balanced Scorecard is highly expensive in terms of cost as well as time. So, thank you very much for following this lecture and see you again in the next lecture.